constitute the closing cost?
So some of the expenses associated with a loan are fixed. Typically, you'll see a very similar appraisal fee on a single-family home or a multi-family home, somewhere between $475 and $600. These are fees that are third-party fees that are pretty much consistent industry-wide. Usually, the bank charges something for underwriting its loan. They might call it an underwriting fee. They might call it a processing fee. They might break it up. But most of the banks do charge something to handle and process a mortgage transaction. And then the majority of the other fees are really legal fees based on the money you're borrowing. And that's where the numbers will change per transaction. Yeah. But typically, in Worcester County or central Massachusetts, if you're purchasing, let's say, an average $250,000 single family home, you should prepare for expenses of $5,000 to $6,000. The second piece of closing on a property is that in addition to the fixed expenses, you're going to be typically setting up an account for your homeowner's insurance and future property taxes. The bank will collect at closing the first year's insurance fully. You're prepaying that for the first full year. And then we're also collecting 3 months property taxes typically and 3 months home insurance. So people are not necessarily informed or prepared for this. So this is another thing we talk about at the beginning of the process, so they understand that, hey, buying a home isn't just whatever your initial down payment is. There's this other piece of it that can be costly. So we try to guide them very carefully, make sure that we're thorough and that they understand all of the pieces to the home buying process and what investment is going to be required from them. One tool we oftentimes recommend right now, where rates are so low, is that they consider a seller credit.
Okay.
Negotiating a seller
And
credit.
that's what the realtors do well. We help them.
We'll let them know that seller credit is a good tool to use, and then we'll if we've had that conversation, we'll let the real estate agent know as well. Hey, when you're making an offer, if a seller concession or a seller credit opportunity exists, to try and take advantage of it, depending on their financial situation.
What about buying down the rates?
Yeah, that's a good question. A lot of people will obviously ask, what is your interest rate? And we'll give them the interest rate on that specific day. Rates change daily and sometimes multiple times per day. In a low interest rate environment, typically we're not recommending that people buy the rate down.
Okay.
So the tool is that in the finance world is that you have the opportunity, a consumer can buy their rate down from whatever the daily par rate is. So as an example, if today's base interest rate with no points is 4%, let's say, the borrower has the opportunity to lower the interest rate by purchasing what's called a discount point. Basically, each discount point equals 1% of the loan amount that they're borrowing. So if they wanted to purchase one discount point and they're borrowing $100,000, they'll pay $1,000. But what is the return? What does one discount point get you in terms of your interest rate? In the current environment, we're only seeing that a point is lowering your interest rate by about 0.25%. So it's not a direct correlation between the point that you're purchasing and the interest rate decrease. You see, so if someone's only going to save a few bucks a month but invest $1,000, it takes quite a while to break even on that initial investment. Where the rates are low, we're kind of recommending, unless they don't qualify and they need to, we're recommending that they do not buy points and keep their money for either invested in another vehicle or just in savings.